Yo, what's going on? Real Estate Coffee Talk, episode 10, and these two are hurting.
Can't believe we've made it this far to episode 10.
Episode 10.
Yeah, all right, so everybody, you need to know, we're going to give you actionable steps to any person looking to buy, sell, invest in real estate, along with real estate industry partners too, or anybody in general.
Definitely. The one I think area of focus in real estate that we haven't touched on yet is like title stuff, I feel like. Because I feel like we touched on investors, first-time home buyers, surveyors. Chris went.
Shout out Chris Went.
Yeah. I think it's funny how we got a surveyor on here before a title company.
Yeah.
Like that would be the last.
That's probably the least sexy part about buying a house is title.
Or a survey. Yeah, I mean, well, survey I guess is kind of part of title, but like.
Yeah, but when you mix Chris Wentz personality, it just makes it all the worth.
It does. It really does. It really does. Yeah, but I think we've covered a lot so far. Made it to episode 10, but today we're going to talk about what's going on, right? Like what's going on in the market. There's so much changing, not only with interest rates, not only with the housing market. It's still competitive, but we're also starting to see a slowdown a little bit. Like obviously we're not, we don't know what's going to happen in the future, right? We don't know that, but I think there's a lot of confusion and misconceptions right now about what's happening and what's going to happen. So I just want to address that and kind of have a conversation about it. I just think it's important.
First, before we get into that, Evan, what is your take? What are you seeing right now? What's happening? Are you seeing anything new? Are you seeing the market kind of soften any? Days on inventory, are they reducing? Are you seeing less offers? One of the agents I spoke to, they said that they only had 4 offers on a house, and that was
only had 4 offers.
you were triple, quadruple that a month ago, 2 months ago.
Right. You could have been, but it also depends on how well was the home priced, what price point was it in. I mean, there's
there we go. This is what I want to know. So tell me about it.
That's the thing. I mean, the house could have had only 4 offers, but had it been priced maybe $10,000, $15,000 lower, it could have had $15,000 over. So that's the thing. Like on my condo listing, we had 3 offers. Had it been listed $10,000 lower, would we have had more? Absolutely.
Right.
Absolutely. So I mean, that's the thing. I mean, if you price it at the top end, like, sure, you're gonna get less offers than if you price it right in the meat and potatoes of kind of where it. Yeah. Not where it should be, but where the range that it could be in. Because anytime you start reaching the top, that's when you're either going to have less offers or you're going to sell for under because the buyers are like, well, this is scratching the top here. There's not much more you can go, right?
Yeah.
So I mean that could play a role in it, but no, I mean from what I've noticed, I'm still seeing multiple offers.
I hope on the podcast I'm going to be staring at you during this clip. I am so sorry, Evan. Go ahead.
The things we go through sometimes.
I turned it off.
It's your own co-host too.
So didn't mean to. Okay, so you're talking multiple offers.
Yeah, I mean, it's still happening. I mean, it's gonna.
Wait a minute, hold on. I gotta clear the. Are we talking about the phone call, or did something else happen?
No, the phone call.
Oh, okay. Because I'm confused. I'm trying to figure out why this is
castrated. You castrated Evan the one time that he had a cell phone, and he kept looking down at it, and then you got over here. You got a Teams call coming in.
Well, I turned it off. I think that was the polite thing to do.
You weren't preventative with it though.
I think people are getting.
Anyways, Evan, please continue.
Yeah. So I just got off track real quick. No, so I mean, I think until the inventory problem is fixed. I mean, there's houses as we get closer towards the end of spring, beginning of summer, more houses are going to come on the market. I mean, those are usually prime selling months. So I mean, there will be more inventory than there has been in the last 3-4 months, but it's still not anywhere where it should be.
Yeah, we're 3.8 million homes underwater right now. We're short. That's insane. First time that I think we've seen that in U.S. history. I mean, the reason why I asked too, Evan, is because, don't castrate me for this, but I was on Realtor.com, okay? I had to go on Realtor.com and by the way, nobody, stay away from those sites. I went on there because I had a client, they were looking like the Euclid area, and we were just going over some general numbers, and I saw one house, and it was like $25,000 drop. It was on the market for 20 days. And I'm like,
I was just
what?
about to say that. Yep. There's definitely some areas that are going down. Like there's some areas where I feel like we're almost back to the market we were in over the summer last year.
Do you think it's because like these
which was still crazy?
Are they because it's not like top end houses or?
I mean, probably just like less desirable areas. I feel like
it could be that, but I think in your not top end houses, I think those are the ones where you're going to have more competition, if anything, because that's where buyers can afford.
Yeah.
Like I'd say, in Cuyahoga County, the average sales price last year was like $180,000.
Yep. Yeah. Yep.
And to factor into that is you also have Cleveland, where there's a lot of condemned and like messed up houses that are selling for $5,000-$6,000. But then you also have areas like Westlake, Rocky River Bay, Brattonall, Gates Mills, where houses are selling for several hundreds of thousands to millions. So,
well, I want to agree with that, but I feel like I've heard of so many like $500,000, $600,000, $700,000 houses who also have 25 offers.
No, they do.
I feel like it doesn't make a difference
to an extent.
You know what I mean? To an extent, yeah, but I definitely think there's some areas that are cooling down.
Yeah,
for sure.
There are some cooler areas, but many of the suburbs. You're still gonna run into that problem.
Sure, it's gonna be competitive.
Medina just had like so Lindsay Businger, she said like 19, or I'm sorry, in Medina was like 13 houses hit the market this week.
Yeah,
there's actually a reason for that. So when you see the raising rate environment, we're gonna pop into this here in a minute, but as the rates continue to rise, David Childs from KeyBank Current Matter said it perfect. Either one of two things are going to happen. Either people are going to be priced out of the market, or go on the fence, or they're going to have that fear of losing out, and they're going to flood the market because they realize that you've sat on your property so long waiting for that top dollar, right? Well, now it's bit you. Right. Now you have to deal with what everybody else is dealing with, so you are going to be forced to sell.
Right.
So I think we talked about this a little bit last week too. Like the people that are holding on to their homes thinking that the values are going to go up, you don't know. Like I think we said this last week. There's no better time than now. Like look at buyers. All these buyers that kept holding out. Yeah. Saying, oh, like it's going to drop. It's going to drop. Right. Look at them now. The same house that they were looking at last year for $150,000 at a 4% interest rate is now $180,000 with a
or more. You had 18% price growth, double digit, and that's been multiple. That's insane.
Well, now, you had your TCA in your example, like I think you did. You've done a cost of waiting breakdown for me before, and the cost of waiting is several $100s.
I got it right here. So let's say that you bought a $250,000 house, right? Let's say that you bought at 5.3 today. Payment with taxes and insurance, mortgage insurance is like $1,915, right? Just an uptick of that interest rate of less than 0.5%, your payment's bumping up to $2,046, and that's a $10,000 increase because we have to think that, and that's very conservative. It's 5%, So if we're projected to hit 8.5 to 10%, okay, we take 5%. The rates are already rising. Yeah, that cost differential is quite a bit. And let's say that you wait. Let's say that we get a 10% raise increase by next year because
values?
Because people are just going to try to flood the market, and the interest rates keep going up because the Fed's already stated, they've already alluded, they're not going to be done until they choke out inflation. So we're going to see progressive growth. NAR economists, Freddie Mac economists, they're all saying the same thing. Let's say that the rates went up to 6%. That payment now is $2,150. $2,150 from $1,915. It's insane.
Yeah. Yeah, it definitely is.
I feel like a lot of people are getting priced out of the market too. And the only reason I say that is because like there's so many pre-approved buyers that we had probably like from a few months ago, like late last year, who can't buy anymore because it's too expensive, but the rates have priced them out. So I feel like when you price so many people out of the market and now you see the market slowing down a little bit and you have all these sellers who are nervous about losing out and you're going to see a slowdown. I feel like that's what's happening.
Well, even with that, so like you said, they got priced out. And if they can qualify, it's for homes in areas that they just don't want to live in.
Right. They don't
and at that point, it's like, okay, well, why? I'm not going to settle and live in an area that I don't want to be in just because that's all I can afford.
Right.
And then that just fuels.
Although some people are thinking like that, though.
No, they are.
We got to do a better job. You're a good agent. You'll flat out be like, listen, you just need to relax and you need to wait. Yeah. Don't be desperate. Especially with people like waiving inspections. But there are a lot of there's agents out there, and there's mortgage planners too that stand behind it. This is like, get in there, you're gonna lose out. The fear of losing out, like you can't. I don't. But
there's
understand.
Also a lot of them who don't.
Yeah.
No, that's what I just said. There's a lot, but there are people in my industry and yours, and they're doing the wrong thing, the unethical things.
So I'm not going to discount that there is a cost to waiting, because there is.
Sure.
But I'm not going to use that to pressure somebody into buying something that they're not comfortable with if they don't want to.
Right.
It's I've had deals that don't work out before where, okay, like they had to sign a lease because they ran out of time or they couldn't find anything, and situations like that. Like, it's happened before. Like, at the end of the day, you can't do anything about it.
Yeah.
And if you do something, if you force them, or not force them, but if you like pressure them, like, you're going to miss out, you're going to miss out, you're going to miss out. They buy something, they're unhappy. Who's never going to send you a referral?
Yeah.
Well,
That person.
It's about education too, like just being ethical and just educating them and just listen. The only thing that we're supposed to be here is that we're supposed to be their coach and their guide, but we're also supposed to be unbiased and just present the facts.
Well, and you're a fiduciary as well, so you're supposed to keep their best interest in mind. And if you're, I'm not going to say it's for your own gain, but if you're putting this fear in them that you're going to miss out, I mean, that's not helping them, because I've noticed that the people that just say, screw it, this is my only option, and then they settle, those are usually the ones that are like not happy with the decision that they made.
Yeah.
That's why I tell people all the time, like, I love it when people, if they are renting, when they're on month to month or they're several months ahead of when they have to put a notice in, they don't have to settle. Or if they're living at home with their parents looking to buy their first home, it's like, you got all the freedom in the world right now.
Yeah.
You don't have to jump. You can take your time. Sure, the market might change a little bit, but you can find the house that you actually like, that you want. You don't have to just jump on the first thing that checks off a couple of your boxes.
Yeah.
You can find like the house.
I think like real estate and like buying a primary house is like, yeah, it's a market, right? It goes up and down. There's good and bad times to get in and out. But like at the end of the day, it's all based on life decisions, right?
It's a shelter.
Because you can't just, if you try to play the market and get in at a good time or sell your house at a good, like, you're going to drive yourself nuts, because it's like pinning your,
You're going to stress yourself out.
You're going to stress yourself out. It's like pinning your, I guess, like your life, because your house is basically your life, against like you know what I mean? Like an investment that you're trying to, I guess, play, if that makes any sense. Like, I think it's just like, if you need to buy a house and you find one, it checks off your budget. It even with the 6% interest rate or 2%, if it fits your budget, checks all the boxes, it's the right price, buy it. If it doesn't, don't. I mean, even if the rate's 2%, if you find a house and you hate it, you don't just buy it because the rates are super low at 2%, which will probably never happen again. But, you know, for example, like a year ago, right? Like, I still think that it doesn't matter. It's all based off of whatever fits your needs at the time. I don't think you should be playing the market.
No, absolutely not. Yeah, because you know what? Anybody that tries to play and time the market, well, guess what? You're going to go broke. You're gambling. Like, you don't gamble. This is like you have your, I love it, the day traders, they're timing the market. Like, no, you can't time it, because that's like telling everybody, I'm going to read your thoughts before you make them, before you put them on paper. That's literally what it is, because the control of money
and
the
guess right.
Yeah,
I'm just gonna guess right.
Yeah, I'm gonna guess right. I'm gonna guess exactly what the Federal Reserve is gonna do. I'm gonna guess, how, what their decisions are gonna be for monetary policies before they release them to the general public. Or I'm gonna know exactly what that bond investor investing in that sovereign wealth fund is gonna think tomorrow.
Right. Well,
before he opens the
not
day
to
for
discount
trading.
that there's not ways to make like calculated risks, right?
There is, yeah,
And like,
correct.
when this happens, do this. When this happens, do this. Okay, yeah, will you win some, lose some? Sure, but yeah, at the end of the day, I feel like with real estate, you can't.
Well, and that's the thing too. I literally just 30 minutes ago, I had this conversation with a buyer. He said, well, he's like, do you think the market's going to crash? I said, from what I've looked at, I don't think it will. I said, there's people on both ends of the spectrum saying yes, and then there's people on the other end saying, no, it's not going to crash. But at the end of the day, we don't know what it's going to do.
No.
We don't know what it's going to do tomorrow. We don't know what it's going to do next week. I mean, that's the thing. None of us have a crystal ball. I mean, at any point it could and crash. But I mean, looking at the data that we have, I mean, I think all signs are showing no, it's not. But that's the thing. Like, you don't know what the market's going to do. I mean, it's good. If it's good right now, just take advantage of it.
Let's have some dialogue, though. If you disagree, bring the evidence. Let's
think
talk.
people are confusing, or they're mixing the idea of a recession coming and the market crash as the same thing. They're certainly not the same thing.
Yeah, no. Well, let's elaborate. A market crash, like recession. Okay, first of all, even in 2008, it wasn't a crash. It was like 50% decline, and but it did not fully crash, and everybody made their money back as long as you kept your money in there. And it doesn't matter what the market does, as long as you had. This is factual evidence. If you have your money in there for 18-month period or longer, it's consistent. It has consistently shown progressive gains since then. And everybody that lost money, they made it back, and you will. Everybody that lost that 30% decline nationally during, anywhere from 2009 through 2012, they made their equity back. Mm-hmm. It's like,
and if they still have the house and more.
Yeah, exactly. So, when I look at it, it's like, okay, well, where can I put my money in towards? Where can I put my money towards? Right, that I'm going to mitigate as much risk as I can. This is why you diversify. This is why real estate, this is why you don't stick all your eggs in one basket. So if you didn't stick all of your eggs in a basket, then you wouldn't be really worried about what the market's going to do, because you're going to have a long position, right? Mm-hmm. You're going to hold that for a period of time because that's a part of your portfolio, right? But unfortunately, 80% of Americans retire on the equity in their own homes, which is honestly, I don't think that it's a good route, because of the fact that you're locked within those four walls. And if you want that money, you got to pay it to somebody else. You got to pay to borrow it. Yeah. So it's only a portion of what your portfolio should be. Mm. So, and then once again, there's literally no evidence that supports that the market, it's a bubble that's going to pop.
Yeah.
They've been saying that since 2013. It hasn't went anywhere but up.
Right. Yeah. It's
significantly up.
Huh?
Significantly up.
Yeah, I'm like actually looking at a chart right now, and it shows that every single recession that we have went through since, and I'll even pull the exact, since 74. Let's see here. There it is. So housing stays strong. This is the S&P Case-Shiller. Okay. But nobody knows what Case-Shillers is. They basically, it tracks housing data, price growth. This is the National Housing Price Index. Since the 1960s, through every recession, it has had positive gains, including our last recession, which we just got out of during COVID, 2008. So that like 2009 through 2012, and we all know why that happened. We had predatory loans. Yeah. Our credit availability matrix. We would give everybody a loan with a pulse and a credit score. Right. We had too much inventory. We don't have 4 million homes. People didn't have equity in their homes. 58% of Americans have 60% of equity or more. The average homeowner has $177,000 worth of equity. 42% of those houses are paid off. So where's the crash coming from? It's not coming, because people can just offload the property. Credit defaults are under 150,000, lowest in 23 years. In 2010, it was 2.9 million. Yeah. So I'm trying to figure out where the crash is going to come. Now, a softened market, we need that. Sure. Yes, I agree.
Yeah, it's going to level out for sure. You know what's funny to me is everything that frustrates us in our daily lives, like short appraisals and clients who can't just come to the table with $0. All of those things are in place so that way we don't suffer what we did before.
Exactly. Thank you. It's like you don't have any skin in the game. If you don't have an investment besides a monthly payment.
It's just funny though. These are the things that make us, they drive us nuts all day, right? Like short appraisal.
I'm not saying that you shouldn't get a house, but you should honestly, I understand everybody's situation's different. Right? But at the end of the day, collectively, there's a reason why there's rules, and you have to have someone investment, because it's like we look at the one person that wants to buy something for nothing, but you don't look at the other side of the spectrum of the person that's loaning the money, right? With that other person not having any kind of vested interest besides a monthly payment, which means they can walk away and get a house in 3 years. Right. You literally could foreclose with FHA and get a house in 3 years. Right. So are we not thinking about all sides, or are we just being selfish and looking at the one person? Because this money doesn't come from us. Right. The money comes from private investors. And if it comes from the Fed, guess where that money comes from? Taxpayers. So that's kind of my take on it. But
yeah,
don't get me wrong.
I just think it's really funny. These things that frustrate us all day. It's this is actually it's a really good thing that appraisals are coming in short.
We need it. We need it.
It really is, because if every appraisal came in at value, I mean, I don't even want to know where we'd be right now. Because how many deals fall apart because of an appraisal? A lot, I feel like now.
No, it's more common recently than
definitely
it has been.
And if that didn't happen and all those transactions closed, I mean,
I wouldn't have a problem with the houses come in and what they bid in if the cost of money was cheap. But people don't look at the fluctuation of the volatility of the cost of money. Yeah. And that's where the problem lies, because nobody had a problem with the bidding wars the past couple of years because the cost of money was almost nothing.
Yeah.
So
Literally almost.
Yeah, literally. Now the price of money doubles. Now everybody's got a problem. Well, you know whose fault it is? Our fault. It's your industry's fault. It's my industry's fault for not educating people because we lack financial literacy. It's sad truth, but it's true. Yeah. We don't take responsibility for this.
I mean, mortgage rates are the 4s and 5s are where rates are supposed to be.
They're historical right
now.
Yeah.
I mean, right now we're in a weird spot, right? Because I think I gave this analogy before. Like, we went through head surgery. Now we're rehabbing, right? And you got to go through
like a rehabilitation period where
it's going to be
back
rough.
to normal.
It's going to be rough, right? It's not going to be smooth sailing. It's not going to be easy. So it's right now is a weird spot, but mortgage rates are 4s and 5s, right? Sometimes maybe high 3s. That's where they belong.
Yeah, historically we've been like, I'm looking at right now 2010s. This is Freddie Mac data. I mean, all right. So the 70s it was 8.86, 1980s 12.7, 1990s 8.12, 2000s 6.25 figures. 2010's 4.09 was the average rate. Now we're at 5.11, but we've had a volatile increase in the past month. Mm-hmm. So if we didn't have that increase, our rates were a moderate growth, and they were supposed to moderately grow in the high 3s and then eventually carry into the 4s, just like they were doing in 2019 before COVID hit.
And then here we are.
And there we are because we quantitative easing, like pumping money into the economy. And don't get me wrong, it's like the housing market, it kept, and I mean, lowering money to basically zero to incentivize banks to loan money and get people to spend because that's what we needed, right? Because otherwise we would literally fall apart if we did not have people spending money. Yeah. But right now, just like you said, rehabilitation, we got to go through it.
Mm-hmm. Yeah, you can't just do all of that we just did as a country and just go back to normal, right?
Sweep it under the rug.
Keep these low rates forever. It's just it's.
Of course, we'll give you money at nothing. You know, that investor is going to like that.
I have something.
Who doesn't like free money?
Well, here's a concept that I've heard recently, and I guess I never really thought about it this way. And I didn't get your take on this, and I forgot to. So, probably when
Forgot.
No, I did. When rates are like in the 5s and the 6s, like this may not make sense, but realistically, when you have a rate like in the 2 or 3s, maybe even the low 4s. Do you think with the way inflation's going right now, that money's essentially free after 10 to 15 years because you're making that same fixed payment, right? But like, I guess the example I would give is like $1,500 now a month is going to feel like $400 a month in probably 10 years.
Well, it's going to be worth. I mean, so you're going to, I mean, so
like you get what I'm saying though? Like, what do you think
as inflation rises?
Yeah, like
but
basically
your rate stays the same. It's almost combating itself.
It's hedging inflation, right?
Yeah. So the way that we look at it is like, so you look at fixed cost, right? So like renting, like the year, like, okay, so a healthy inflationary. So deflation, obviously, as we know, is extremely unhealthy. It's even more unhealthy than inflation. But so inflation, I mean, we need it like 2%. That's what we need, right? Mm-hmm. And our wage increase is like 6.5% to 9%, depending if you're public or private sector. So, you know, the reason why housing is unhealthy right now, and this is, everybody's listening, this is why you need to stop the double-digit price growth, is because it's exceeding the cost of wages of what they grow in, right? So that's your hedge. Now, it's good to own a house because that's a hedge no matter what inflation does, right? But rent goes from 4% to 11.8 in 1 year, right? So, I mean, at the end of the day, if you're looking at it from like an inflationary standpoint of protection, yeah, housing 150% is going to be your best
bet. And
bet.
I guess my thought is just like, okay, if the money costs you 4%, right, 4 or 5%, and inflation's like 6%. Like,
oh yeah, it's a no-brainer.
Free,
yeah, it's a no-brainer. Yeah.
So like, I don't know. I guess that was like, and I don't think anybody really thinks about it like that way. You know what I mean?
No, I mean, but here's the thing.
Yeah, you're paying 6% for the money, but you're gonna, get 4% of it back in inflation. So really, the cost of money is like 2%.
Yeah, well, I mean, if you're looking through like historical averages, like I'm looking at them right now, so like in the 1990s, inflation was like 3%. Home growth housing price was like 4%. 2000s 2.6%. 2010s 1.8, 1.4. Now it's 6.8. So yeah, if you're out there, if you can buy a house and you're just worried about the interest rates and the cost of money, listen, every homeowner refinances on average 3.17 years, and you're not going to stay in your house for more than probably 8.17 years anyways, because that's the national average. Right. But it's either I'm sticking my money into rent, or I'm going to invest at least principal equity, and I'm going to hedge against inflation, and I'm going to make my money when I leave, or when I decide to sell. So how long do I plan to hold that position? So in my eyes, it doesn't. If anything, as inflation rises, I'm going to buy a house.
Right.
And I'm going to capitalize on the opportunity when I have it to restructure that debt. So hopefully, I think I'm on the same page as you.
I think so, because once you borrow that money, it's
there.
It's not going anywhere, no matter what the value of that dollar that you borrowed is. It doesn't matter.
Yeah, if anything, you should be sitting in a better position. You're like, okay, I don't care what inflation does. I mean, my housing's fixed. Mm-hmm. So yeah,
it's interesting.
And it's crazy is because when I sell my house, it's going to be at the current value of money.
Right.
That's even better.
Right. So that's a good way to think about it. Yeah. It's like if you're on the fence, I don't want to pay these high interest rates. Okay, but think about inflation. Think about the appreciation growth you're going to get. There's so many benefits other than just you own a house and it's yours, and you're not paying 100% interest. I feel like that's the most cliche thing. Renting is 100% interest. Yeah, it is, but there's other benefits, right?
Yeah, I mean, long-term, commitment, but, there was something else I wanted to say. Oh, so that's actually, Sam, that brings me up to the next point. That's a really good point that you brought that up. Mm-hmm. So when we're talking about inflation, they definitely need to raise interest rates, right? This is good. Yeah. So you settle it down. So this all kind of pulls in, so I don't, at the end of the day, I believe I'm a big proponent of raising the cost of money, slowing things down. It's all for our best interest.
It's a good cause, yeah.
Yeah, 100%.
Definitely. Okay. I think we'll take a quick break here, and then when we come back, I just want to talk quickly about the forecasted, what we have forecasted with the inverted yield curve and a recession, and just kind of what we're seeing at that point. I think we addressed a lot of the concerns on why the housing market's not going to crash.
Most importantly, dad joke of the week.
When we come back. Not yet.
Okay. Yo.
Welcome. Damn.
Yeah.
There's a microphone right there, bro.
I know. Right. No. You're like, my hair got caught in a little.
Yeah. Dad joke of the week. You guys ready?
That hurt.
All right.
I can't believe you didn't react to what just happened.
He's too excited about his dad.
Yeah,
joke.
did you?
No, it's just normal, man.
Did
It's
you
just
see that?
What do you mean?
Yeah, he busted his head against the microphone.
It looked like he got shocked by them. No, he
put this on do not disturb. Put it away.
All right.
Can't have another Sam.
Edit
Wait
that.
I thought
Edit that
Shella
out.
was coming here.
No, she was, but she had she totally forgot she had a workout commitment.
Oh, okay.
Yeah. So why do fathers take an extra pair of socks when they go golfing?
Why, Dustin?
No, I already know the answer.
In case they get a hole in one.
Yeah. Real funny.
Actually, pretty good one.
I know, right?
Because
Well, here,
big,
okay.
big golfers.
Actually, I got another one.
I heard
Big
that.
golfers over here at.
Okay. All right. How do you follow Will Smith in the snow?
You slap him.
What?
How do you follow Will Smith in the snow?
The Fresh Prince.
Dude, I don't know.
You follow the Fresh Prince.
All right, I got one more.
You slap him is a valid.
I thought we were having a dad joke of the week. This is 3 dad jokes of the week.
Fine.
Dad jokes of the week.
Actually, no. It would make sense because we do need to backdate it since we missed one last week and then we didn't do an episode the week prior. So I'll grant an exception.
Wow.
I thought the dryer was shrinking my clothes. Turns out it was the refrigerator all along.
All right. I don't get that one.
I don't
It's because
either.
he's eating too much.
Oh, yeah. Good one. All right. Way to be
dryer's
quick on
not
the quip, buddy.
The dryer's not shrinking the clothes.
Yeah, I
The
get it now.
refrigerators.
What? Okay. Yeah.
Sam, you're like 12.
He read it and he didn't even get it.
That's what I'm saying.
All right, anyways.
Back to
No
our
more.
scheduled program.
So what are we headed towards? What are we headed towards? Obviously, signs point towards a recession, not a crash.
Yeah.
Is that what's going to happen?
Well,
Who knows?
historically, every time we've had an inverted yield curve, we've always had a
So
recession.
Explain that.
Yeah, let's explain a little bit.
An inverted yield curve. Okay, so you have yield. Yield's what bonds pay. Okay,
Right.
so bond is
Short-term,
a
long-term, right?
Yeah, it's a debt. Okay, that's loan. Okay, you pay it back. Mortgage-backed security is, for an example, it's a bond, a debt tied to collateral. But you're going to have different periods of time. So, for an example, you're going to have people that want to invest their money for 3 months and they want it back. Or they're going to lend it. They're going to lend it for 2 years, 5 years, 15 years, 10 years, 30 years, whatever it may be. So, the theory is if I loan you money for a longer period of time, that's a higher risk to get my full investment back. Because when you pay a bond off, not only do you get your interest, whether it's a 6 or a 12-month period, annualized or not, you're also, when at the end of that note being due, they pay you back the full amount, right?
Right.
So you
that would make sense. Sorry, super quickly.
Yeah.
That makes sense why 15-year mortgages are typically better pricing.
Yes,
right?
100%. Yes, absolutely. And there's no guarantee, too, is because a bond, if a company goes, if they, for an example, if they go out kaput, bankrupt, right? Mm-hmm. That debt, who's going to pay the debt, right? So, the theory is the longer that I loan you the money, the more I get paid. Now, when you have short-term debt that's paying longer than long-term debt, which currently the 3-month was paying more than the 2 and the 5-year, that is signs that investors are like freaked out. They see something coming, and we have signs of a recession in every point in history, every single inverted yield curve, and it is irrefutable. It always leads to a recession. Now, the timing is the $1 million question. Is it 6 months to 2 years, whatever it is, but it's probably coming because we have already seen signs of the inverted yield curve in the past 3 months.
Right. And what typically happens when we have a recession in mortgage rates? They typically move down.
They go down. Historically, they have went down every single recession throughout U.S. history.
So
why is that, though? Why is that? Because we need to,
boost
when you have
the economy.
You need to get people, because people, when you have a recession, they go into hibernation, right? Mm-hmm. They don't want to spend money. They're scared, or there's jobs lost. Right. We have to incentivize them. So that's when you pump quantitative easing, just like we saw during COVID.
Yeah, exactly.
Yep.
Why the rates dropped during COVID? Same idea.
Yeah.
So I think something to take away, if you don't take anything away from this whole episode, and you're somebody who's thinking about buying, if you don't want to buy right now because of the cost of money, right? Even though we told you exactly why it doesn't matter realistically. You can look forward to, if we're headed this direction with the recession, you will see probably rates drop, and you will probably have the opportunity to refinance again. Are we going to see rates in the? God, I think. Did you? I didn't. Didn't you lock like a 1.99 last year? On a 15-year like VA Earl or something?
No, it was like 2.125.
That was low.
Same thing.
Pretty much. It doesn't matter. I mean, I
heard there was like a 1.98.
Yeah, crazy. I don't think that, obviously we know that's never coming again for the most part, right? We could pretty much say it's probably
unless we get a national pandemic again or global. I mean, come on, bring it on.
But
that's the case.
Which
I don't want that.
Yeah. Yeah, please don't.
Yeah, no. But these rates that are going up right now, they're continuously going up. It's pushing people away. I wouldn't be so scared of it because of that. Like, you're always going to have that to not look forward to, because the recession's obviously not good. But what if you buy a house right now and you get a loan at 6%, you're not stuck in it forever, even if you don't sell the house. I think that's the bottom line.
That's why refis are a glorious thing. Yeah. Because it gives you the opportunity. Okay, sure, right now that might be what the market is, but look at all these people that had anywhere. I mean, they had rates that were similar to what they are right now. Yeah. And when the rates dropped.
Yeah. 4 years ago, I was 5-6%, 100%. It was there, and they're sitting in the
even like early 2019.
Well, it comes down to two. It comes down to like your mortgage planner, like really like coaching you on this and monitoring the mortgage, like. A lot of the times the mortgage planners will, or loan officer, should I say, not a mortgage planner, because a planner is a planner. They'll write the debt, they'll disappear, right? Just like some agents will get you in the house and they'll disappear and they won't stay in front of you, right? So it really works too for the agent and the mortgage planner to obviously work and coordinate with each other throughout. Just, because God, come on, like this is the largest financial debt you take it. Like
it's a big deal.
Marketing companies make it seem, I'm not going to say any names, but they make it seem like, okay, click a button, here's your mortgage. No guidance, no direction.
Yeah, here's a payment.
Here's a payment.
Best rates.
Yeah, how's this going to work with you? How's this going to correlate with retirement, college funds? What are your short-term, long-term goals? That's another thing, too, is when people are taking the interest rate out right now, they're thinking, oh, my God, I'm going to take 6%. I want that low rate now. You got to have delayed gratification, okay? You get it now. You delay your gratification, and at a later point in time, when the timing is right, you get a lower, because, listen, it is a fact. Clients stay in their house for 8 years. Every single 3 years. On average. Yeah. But we have a recession every 7 years on average.
Right.
So you know that your rates are going to drop at a later point in time, but it's having that clear direction is the problem, and that's where we fail.
Mm-hmm. Definitely. I think that's the one takeaway to take away from this episode. Like, is the market going to crash? No. maybe, probably not. More than likely not. That's what the signs are pointing towards. Are we going to see a recession? Probably. What is that going to mean from rates? Probably going to move down. But like I still think it's a good time to buy.